I'm Joe Evans. I'm Chairman and Chief Executive Officer of State Bank Financial Corporation, and I'm here with the Bank Director Boardroom Forum on Lending, both as a participant and as a speaker. Our strategy for lending money is to be very value-oriented and to focus on highly skilled acquirers of commercial property that are very well capitalized. And we have been banking real estate investors whose approach to real estate somewhat mirrors our approach to banking. And that's that we're somewhat contrarian, that they are by and large investors that survive the downturn, which means that they must have done something right in the better times, that have the capital and the investment discipline to make the numbers work on low leverage projects. So we continue to like lending on real estate. Now, we also believe that it's possible to achieve significant risk diversification within the real estate lending sector. And we pay a great deal of attention to geography. You don't want all your loans on the same block. To type of loan, we're making actually some construction loans right now. There are some submarkets of Atlanta that have stabilized to the point that there is some new construction going on. We've done some multifamily, we've done some student housing, we've done some medical office, we've done some hospitality, we've done some retail. So both type of loan within that broad umbrella of real estate lending and geographic diversification, we believe that we're building an appropriately diversified portfolio, but staying within the confines of where our primary expertise is. Now, we very much would like to add to the breadth of our expertise, and we would like to do that with an acquisition that would bring a new skill set to the table for us, such as a small denomination asset-based lender or a small ticket leasing company. Well, our bank was created after the downturn. So I say this from the perspective of being in business from summer of 2009 forward. It really has been favorable for us because valuations have fallen substantially from their cyclical highs preceding the downturn. So the ability to make real estate loans today at more conservative valuations and with much more conservative terms on the loans in terms of higher levels of cash equity being required, debt service covenants, we're making more conservatively structured loans at much more attractive valuations today than banks were making 4 or 5 years ago. So when you take into account the fact that we have the capacity to make real estate loans in this environment by virtue of the loss share coverage that we have for all of our legacy portfolios, then there is a certain advantage that we feel. We felt that we made some of the best real estate loans that we'd made up until this point in time back in the RTC era, which was another moment of cyclical downturn in real estate, a contraction of the amount of credit capacity available to real estate. And in that era, as in now, we believe that we have once again the ability to make very well margined, very well structured real estate loans on much more conservatively valued properties.